All right, let's jump right in. Today, we are going to do a deep dive into the tax code, but we're focusing specifically on something incredibly important: the tax credits available for the millions of grandparents who've stepped up to raise their grandchildren. You are playing such a vital role, and believe it or not, the tax system actually has tools designed to help you. So, in this explainer, we're going to walk through exactly how you can get that support. Look, you're already providing the love, the home, the stability, all the really hard stuff. Our job here today is just to make sure you're not leaving any money on the table, money you've absolutely earned and that can make a real difference for your family. So let's get to it. Okay, so the very first thing you need to understand is this. Almost the entire world of child-related tax benefits opens up with a single, crucial first step. And that step is being able to claim your grandchild as a dependent on your tax return. Getting this right is the foundation for everything else we're going to talk about. So, what exactly is a dependent? Well, in plain English, it's just someone who relies on you for financial help. But to the IRS, it's a very specific, very official status. You really should think of it as the master key. Without it, the doors to things like the child tax credit and other big benefits, they stay locked. Now, the IRS gives you a couple of ways to claim your grandchild. One is as a qualifying child, and the other is as a qualifying relative. And while you can get some tax savings with either one, I'm telling you, one of these paths, the qualifying child path, is so much more valuable. Let's dig into why. To meet that qualifying child gold standard, your grandkid has to pass 5 tests. Now, the first 3 are usually pretty easy, right? They're your grandchild, they meet the age limit, and they lived with you. And that last one about filing a joint return, almost never an issue for a child. But that fourth one, the support test, that's where things can get a little confusing. And please listen closely to this part because it's the number one thing people get wrong. The test is not asking if you paid for more than half of their expenses. It's asking if the child paid for more than half of their own support. Why does this matter so much? Because things like Social Security survivor benefits or foster care payments made for the child do not count as support the child provided. This one little detail is an absolute game changer for so many grandparents. You can see the difference pretty clearly laid out here. The qualifying child rules are just more flexible, especially when it comes to income and that support test. And look at the payoff. The main benefit is that huge $2,000 child tax credit. The qualifying relative path has much stricter rules and a much smaller benefit. This is exactly why it's so important to aim for that qualifying child status if you can. So you did it. You figured it out, and you can claim your grandchild as a dependent. What happens next? Well, now comes the fun part. You've just unlocked the ability to claim some of the most powerful tax credits out there. This is where all that effort literally pays off. The biggest prize, by far, is the child tax credit. For the 2025 tax year, we're talking about up to $2,200 for each qualifying kid. And this isn't a deduction, it's a credit. That means it's a dollar-for-dollar reduction of any tax you owe. If you're raising 2 grandkids, that's potentially $4,400 right back in your pocket. But there are a few extra hurdles for this specific credit, so you gotta pay attention. Your grandchild must be under 17 at the very end of the year, on December 31st. They also have to have a valid Social Security number, and ITIN won't work for this one. And, of course, you have to be claiming them as your dependent. Now, this next part is huge, especially if you're living on a fixed income. A big chunk of the child tax credit is refundable. So what does that mean? It means that even if you owe $0 in federal income tax, the IRS could literally send you a check for up to $1,700 per child. It's called the Additional Child Tax Credit, and it's real money designed to help families who need it the most. So what happens if your grandchild is a little older? Maybe they're 17 or 18. Or what if they don't quite meet all those tests for a qualifying child? Don't worry, the tax code has a backup plan. It's the credit for other dependents. This credit is worth $500 for each dependent who qualifies. It's perfect for those grandkids who are 17 or 18, or even college students up to age 23. It's also the credit you get if your grandchild falls into that qualifying relative category. The one key difference? This one is non-refundable. That means it can reduce your tax bill down to 0, but it won't ever result in a refund check. Okay, we've got to talk about what is probably the single most common and honestly most confusing situation for grandparents. What happens when the grandchild's parent also lives in the same house with you? This creates a tax puzzle, and the IRS has very, very specific rules about how to solve it. This is the big question, right? If the grandchild could be a dependent for both you and their parent, Who wins? Can you just decide between yourselves who gets the bigger tax break? Well, according to the IRS, the answer to that is a hard no. You can't just agree, you have to follow their rules. The IRS settles this with something called tiebreaker rules. Step 1 is dead simple. The parent always has the first right to claim the child. If the parent is eligible and wants to claim them, they win. End of story. But, and this is a big but, if the parent decides not to claim the child, then we move to step 2. And step 2 is all about who has the higher income. So, here's the bottom line you have to remember. Even if the child's parent gives you their blessing and says, go ahead, you claim them, you are only legally allowed to do that if your adjusted gross income, or AGI, is higher than that parent's AGI. The IRS computer systems are actually set up to flag this, so it's super important to get it right. All right, let's switch gears and look toward the future. Because filing your taxes correctly is one piece of the puzzle. Being ready to defend your return if you have to, and planning for what's coming down the pike, that's the other piece. We need to talk about audit proofing and some really big law changes that are on the horizon. It's just a fact of life. Tax returns that involve kinship care situations like this tend to get a closer look from the IRS. Now, I'm not saying this to scare you, I'm saying it to prepare you, because the absolute best defense against a letter from the IRS is having all your proof ready to go before you even file. So what kind of proof does the IRS consider the gold standard? They want official documents from a third party that proves the child lived at your address for more than half the year. School records showing your address are perfect. Medical bills, immunization records, letters from a daycare or a social worker. These are the kinds of documents that make responding to the IRS a breeze. And finally, you absolutely need to have this on your radar. There is a huge change coming. Some people are calling it the 2026 tax cliff. The laws that created this $2,000 child tax credit are set to expire at the end of 2025. What that means is unless Congress passes a new law, that credit will get cut in half, back down to just $1,000 per child for the 2026 tax year. And it gets a little worse. Remember that $500 backup credit, the one for older kids? Well, it's not just getting cut. After 2025, it's scheduled to go away entirely. Just poof, gone. This takes away a really important benefit for families caring for older teens. So all of this brings us to one final, really important question for you and your family to think about. When these tax laws change in 2026, and they are scheduled to change, will you be ready? Knowing that this is coming gives you the power to plan your budget. It highlights just how critical it is to get every credit you're entitled to right now, while also getting ready for a very different tax world just around the corner. Being informed is always your best strategy.